Srinivas, Janet Yellen said this week that she's going to be patient for a while. So tell me, when does she finally raise rates?
They're probably not going to raise rates at all this year, and probably not in the foreseeable future. But the fear that the Fed will actually raise rates might still reach a crescendo in the next month or so, or a couple of months before it eventually fades, because the Fed is not going to be able to raise rates.
Meanwhile, over in Europe, you have stocks flying and yields plummeting. Now you have to pay Germany to hold your money. So is this a good thing? I know it's got the economy moving, but is it going to eventually hit them in the end?
What's got the economy moving actually is not the yields, but two things. One, oil prices declining, which is a big bonanza for Europe. It's about a percentage point of GDP boost to their profits from a flow of funds perspective. And number two, the weak euro, which is helping them gain market share in their exports, and their trade balance is expanding rapidly. So those are the two big things. It's not rates, because credit is really not growing. What these negative rates, especially in Germany, reflect is people's perception of what is a safe asset has shrunk, even despite all the efforts of the ECB. And so they're just scrambling, and they're willing to pay even a premium to protect their capital.
Do you see an end result in all this?
Well, there's ultimately people, when they want to protect their capital, they want to protect their capital. They don't want to see it whittled away, So a negative rate is not a good thing. People will eventually try and find a way, but it's just a way the world is, that this got no good ending, obviously, clearly.
All right. Over in emerging markets, they love low rates, always have. And actually, you see emerging market stocks second only to Europe, and they're ahead of the S&P this year. That said, there's geopolitical problems in a lot of the emerging markets, down in Brazil, over in Russia. What's going to win out?
Well, it's not just the clearly the geopolitical problems, especially for Russia and for the Middle East, that's the issue. But emerging markets have a deeper structural problem. Clearly, they are being helped right now by the lower rates. We've had a massive rally in rates. And emerging markets over the last several years, their dollar liabilities have increased. So a decline in US rates obviously helps. But they have a longer structural problem. The structural problem is they had this export-dependent model, and they're moving away from it because they're not able to export. European imports and US imports are stagnant, non-oil, and so they really have to find a new model, and that's not easy to do, that transition, and that's where they're struggling with, and that's a long-term transition.
And then finally, I guess if you consider it a horse race between the US, Europe, and emerging markets, and you had to rank them win-place show, how would you do it in terms of your confidence in these economies?
Oh, the US clearly is the winner, because we are much more in control of our own destiny. And our own domestic economy, we have still some long-term issues, but we have done much more to repair our balance sheets. And we have the wherewithal to do the right things. Whereas Europe has many political issues to deal with, but they do control their destiny to the extent they can get their political house in order. The emerging markets are much more, ex-China, the emerging markets are much more dependent on conditions in the developed world, especially the financial conditions, so they don't control their destiny.
All right, win-place show. Thanks a lot, Srinivas.
Thank you.
And thank you for watching The Street.